I think we already had an amazing morning, and throughout the morning, we've heard about how we have a lot of demand coming at this industry. And so we're going to need to drill more. We're going to have to build more pipes to move that product. We're going to have to export more through LNG. We're going to need more gas generation projects. We're going to need more renewable projects. We're going to need more transmission lines to move it all. We're going to need more nuclear. And that's all going to take a lot of loot to do. And so the question that this panel is going to attack, or the questions that this panel is going to attack, is related to the capital. Where is all that capital going to come from? Who's going to provide it? What's it going to cost? What are the structures out there? What's not going to get funded that needs to get funded? So I think it's the right time to have this conversation, and we have the right folks up here to have the conversation with. There's no boots here. There were some boots on the last panel. That's because these are the financiers and the consultants and the research experts, and so we're gonna talk about all that. But to start, I'd love for each of you to just introduce yourselves and give a little bit about the background of yourself and your firm and how you plug into the capital markets and in that world. Maybe starting with you, Dennis.
Sure, Dennis Cornell. Am I good?
Not yet.
Keep trying.
All right, why don't we start with you, Steve,
Actually, I'm
and we'll go the other way.
I'm Dennis Cornell. Yeah, I'm happy to start. First of all, before I introduce myself, I want to say, first of all, fantastic that USC is hosting this. Fantastic that you all have an energy program here. And congratulations to all of you for being here. They say it takes a village. It takes a lot of people to drive what's going on in the energy sector. And they're not just all coming out of schools out of Texas or Colorado. We need folks like yourselves who are engineers, who want to go into the financial side, material sciences, et cetera, AI analytics. So extraordinarily excited to be on the West Coast of all places. My first time to be here speaking about energy, candidly, other than a couple energy clients that are based here. But I just want to say congratulations to you guys. And you were also extraordinarily, the panel you had here last, unbelievable all-stars in the sector. You guys were blessed to have these guys here talking about what they do day in and day out. And it was a pleasure for me I hear them all the time, but it was a pleasure for me to sit and hear that too. So anyway, by way of background, I'm Steve Trauber. I'm chairman of Moelis Energy and Clean Tech business. I've been in the investment banking business for 37 years. I've run some of the larger energy practices on Wall Street. Before coming over to Moelis, I ran Citi's global energy practice, power and clean tech business, and then came over to Moelis. Today, surprisingly, we're the largest energy franchise on Wall Street. And in the last 18 months, we've gone from 40 bankers to 84 bankers and still hiring. And that's because of all of the activity that is going on in the energy sector that you just heard from the previous panel. All the capital that needs to be raised, all the growth that's going on, all of the realignment, not just domestically, but globally. So I'm glad to be here. Thank you.
Yeah, so I'll jump in. Can you guys hear me? Maynard Holt. My background was investment banking, like Steve's. I worked at Goldman for about 13 years. And then really the formative energy experience of my life was as shale was exploding. And the funny thing about that last panel, shale used to be this bizarre, high marginal cost, it'll never work thing. And then it revolutionized the country and the world. So the next time someone tells you something is bizarre and overpriced and won't work, keep your mind open. But we started a firm called TPH, which sat really right on top of the shale revolution. And so it was a research and investment banking firm. And we did that up until we started Veriton. And I would say the quick introduction to Veriton is if you're feeling a little confused based on what you've heard so far this morning, like, wow, that's a lot, and how are we going to do all that, and how's that going to work out, and where do we get the money, and how do governments play a role, and I hope we don't have too many wars. If you're having that kind of feeling, that's exactly why we started Veriton. Because if you think about the energy debate, the energy discussion, it's full of all kinds of actors with different objectives, different philosophies, different technologies. There is a agenda around a lot of different issues. And so we just said, we're going to start a company that tries to figure it out. And so the way we try to figure out is in a few ways. One is engaging with anyone who'll talk to us. So we've had a podcast for about 5 years. Sean is the star. Sean Hyatt here of USC is the star of this week's podcast. We did it yesterday here at USC. But it's just talking to anyone and everyone who has a view. And there are so many views. So we do that. We do a lot of strategic work with companies, because what I'd say, we'll get into it, is the public markets are very confusing for strategy, right? Because if you're in a boardroom, it is hard not to listen to your shareholders. In fact, Steve will tell you that's one of the worst things you could ever do, is not listen to your shareholders. But your shareholders have very strong ideas about what they want you to do and what they don't want you to do. And they also get paid annually. So they're not good 10-year thinkers. And so we do a lot of work with companies thinking about how to build the business for the next decade. And that's just not an easy thing to do. And then the last thing we've done is we've started our own investment fund. And I would say this has been arguably the best thing we've done, because you can debate all kinds of things. You can think this is right, that is right. I think we should go that way. Society should do this. You can have all kinds of opinions. But when you sit down and look at investing in something with your own money, it really, you sit up a little straighter and you ask another question, and then you ask another question, and then you stress about it. And so that doing our own investing has just been really useful to trying to understand how the world is really going to play out.
Great.
Fantastic. Dennis Cornell. I've had 3 different jobs in my life. The first was a nuclear engineer on a submarine in the United States Navy after college. Then after business school, I overlapped with Steve at Morgan Stanley for a while. And then the last 8 years there, ran our energy group out of Houston. And then I joined Apollo 4 years ago to run our corporate origination effort. And why is it interesting to this conversation? Apollo has gone from over its 35 years of existence from a private equity fund into much more of a credit fund. And today, we sit on nearly $1 trillion of capital, a majority of which is focused on investment grade assets. And the duration of our capital is very long. And so we're kind of like an anti-bank in a way, right? Banks every day, as we've seen during times of crisis a few years ago, their deposits come in on a daily basis and can leave on a daily basis, and they lend long. We have long duration deposits, or average, not deposits, liabilities. They're about 14 or 15 years. And it's through an annuity business that our CEO started right after the global financial crisis. And thus we really enjoy duration. And so for the infrastructure needs of the world, that's particularly relevant capital, because infrastructure by definition is usually very long duration. And so we're looking to deploy billions and billions, and we see opportunities everywhere. And I will say I'm not only focused on energy anymore, I focus across the entire economy. But we see the United States, the world, awash in capital needs, and we think we'll play a very, very significant role in supplying a lot of that capital.
Great, thanks, Dennis. And just so you all understand my perspective, I'm the Chief Operating Officer of LS Power. We're an energy infrastructure investor, owner, developer, operator, anything U.S. grid related. So that includes conventional utility scale generation across the renewable generation complex, as well as distributed resources. And we have around 14, I guess I should have introduced myself for Apollo when over here. We have around 14 billion under management in our private equity business, and about 6 billion in rate base in our transmission platform. So let's start talking about the capital flows. And I think we're just going to work our way through the value chain, starting with upstream and midstream. Steve, maybe you can talk a little bit about where that capital is flowing into. What kinds of opportunities are getting funded in that area right now?
Look, I think the one thing to know is there's plenty of capital out there. Let me start with that. You just heard Dennis talk about $1 trillion of capital. He's not the only firm that's got a substantial amount of capital at LS Strategics. So the capital is available, point one. Point two is it is flowing into the upstream. It's still, it's not necessarily flowing as rapidly as we'd like to see it in the public markets. But in the private markets, there's a lot of private equity firms still out there, private credit's still out there. strategics are funding. These are increasingly going into larger and larger projects. Shale is getting to a point where it hasn't rolled over yet, but it's starting to roll over. I think it's going to be a lot more prolonged than people think it will be, because I think technology will prolong it. When you think about, we talk about upstream and downstream, I think a lot of the capital right now is going into infrastructure.
Yeah.
We talked about, the last panel talked about all of the pipelines needed, but the other thing they talked about LNG, but they're not talking about is how much capital is going into the pipelines and the liquefaction and ultimately the regas and the storage in order to make LNG real. Right, allowing us to take it from the U.S. and take it to our allies, take it to Asia, take it to Europe, and we need to do that. And that takes billions and billions of capital. These LNG projects are 10, 15, 20 billion dollars. I'll give you a sample. Alaska LNG, which is just starting to be thought about right now, $50 billion when you think about the pipeline, the storage, the regas, the liquefaction. Talking about $50 billion in a complex of a project in order to take gas from the West Coast into Asia. When you think about that, we need not only develop the infrastructure, we're going to need to continue, as Toby talked about and Tom talked about, our reserves. We have plenty of gas here. We have substantial amount of gas, and I think we have more gas than we understand we have, and I think that'll show up over the next several decades. But we have to be able to get it out of the ground. So we need to continue to put capital into the upstream and into the midstream to allow us to take it and deliver it to where it needs to go. So tremendous amount of capital needs in this country going forward in order to develop our resource base.
Yeah, and that covers just the upstream and the midstream area. We're going to have to put a lot of capital into the downstream part of the business, or the grid, if you will. And Dennis, we had a sidebar just a short while ago, and you were talking a bit about the kinds of conversations you're having with utilities and regulated players in the space. And just for everyone's context, when you think about the grid and the generation, the transmission and distribution, you'll have large utilities that are investing in these assets, and then you also have the independents that are coming in and investing. Maybe talk a little bit about what you're seeing in the transmission and distribution part of that area.
Okay, fundamentally, going to Steve and coming off of Steve's comments, if you think about the energy space and the utility space as a whole, the S&P is dominated by a few players. We know that. Everyone talks about the Magnificent Seven and the fact that you're really so correlated to their results if you invest in the S&P 500. And what it really is crowded out, back in the early or last decade, at the end of the last decade, the energy sector was 2% of the S&P 500. It's probably not appreciably more today. 4, and the utility space is 4, right? And so when we think about funding these large projects, right, we think about, and I'll talk a bit about what Sempra did last week. It's public, and so I could talk about that. If you think about that, it's not going to be all debt, right? It can't be all debt, right? We did a very large deal for a chip manufacturer that needs equity funding, and the equity markets are going to get swamped by the needs of the energy space and by the needs as they transition, as we do all of these large-scale projects. So the equity and the debt market, we don't think really are the answers. And so let me quickly talk what Sempra did, if folks saw that last week. They raised $17 billion of capital without going to the equity markets, right? They sold $10 billion in their infrastructure business that took them from majority to a minority to focus on the utility space through OMERS and KKR, and then through a very creative structure, they financed, as you were talking about, Steve, the LNG space with Port Arthur 2 for another $7 billion of capital without ever going to the equity market. And what did the equity markets do? They rewarded them. The stock price was up 5-7% last week because they solved a huge equity gap that they thought was going to come in the form of common shares. And so we see on the utility side much the same, which is a space that has been relatively low growth, right? Rate-based growth, sure, but not really investing heavily in T&D and baseload expansion, now being stressed. And it all starts, obviously, with the upstream AI and the massive spend. And Darby and I were talking about this, whether it's 100% of what's projected, 50%, 75%, it's going to be a massive number. It's going to be trillions and trillions of dollars. And if you talk to the Googles and the Metas and the Microsofts of the world who are producing $100 billion of free cash flow a year, they all have their objectives, and most of which are not to be asset-intense businesses. So there's a big, massive funding need not only for the base load, which will be, as Toby and the team were talking about the last time, a lot of gas. Right, there's
Yep.
only so many 3 Mile Islands that get restarted, and so much nuclear. As somebody said last, it takes 15 years to build something from the beginning to actually going and producing electrons. And so the utility space is swamped with capital needs right now. And what the beautiful part about the utility space is they tell you exactly what they need. Right, you can look in their investor presentations and you can understand for the next 5 years their capital budget, how they're going to fund it between debt, equity, and hybrid equity. And we believe most of them are sandbagging. We think that their numbers are very low, and not because they're trying to be cute or anything else. I just think that there's going to be a lot more capital needed in that space. Again, go to Sempra. Their needs of capital are between $550 and $100 billion over the next 5 to 10 years. It's massive. And so our capital, and it's a much longer conversation than most of you would want to hear, we can deliver equity capital with non-dilutive equity capital for a sub 8% cost for just about any investment grade company that we can structure. And it's very, very attractive as folks think about the equity markets and accessing them, or trying to do something with the debt market solely, where they're likely to get downgraded.
Yeah, and we're going to have to come back to that because there's some interesting stuff there. But Maynard, I want to go to you as well and get your thoughts on capital flows, and in particular around what you're seeing and thinking about on the nuclear side, just given
Sure.
how much discussion there is around that asset class.
I think what's interesting in all this, and you think about the last kind of the 2020 to today, this period of the energy discussion, and how many flavors have been up and down, and how many policies have been pushed one way or the other. It's been quite a period of, usually don't see that much dramatic change in 5 years. And so it's been pretty incredible. But the key question, I think, with any of these things, whether you're talking about, are we going to do all this AI? Are we going to do, pick a flavor? The question is, are people going to make money doing it? And so for the AI, it's interesting, the tech companies, pretty fascinating. They're going from being companies that did not spend a lot on capital expenditures to companies that are spending, I think the handful of the biggest ones, maybe $300 billion a year. So suddenly they are becoming wildly capital intensive. So that means if they're going to spend all that money, they're going to have to find a way, create a lot of value, and then charge people. So I just leave you with that, because every time there's so many hockey stick projections in the world, and they've been tons of them around for the last 5 years in particular. We're going to do this, and we're going to do this. We're going to spend, forget the month, at one point we were saying we're going to spend $1 trillion a year for 30 years on energy transition, or these types of numbers. And you go, who's spending that? Like, why? Because people ask for a return. And governments are maxed out. The story in the Western world is we have so much debt on so many government balance sheets, so they have to modify how they approach all this. But, so that's my first point, is just thinking about the economic return. And then I think that the second point on power that's been really interesting, which will lead into to nuclear. Power, even before AI, was a real mess. It was really bad. And the problem, when you think about it, is, first of all, it's multiple jurisdictions. There's not like one power system or one power market. It's multiple. And then, of course, it's country by country, state by state, so on and so forth. Secondly, it has all the problems with doing anything of scale that we have. I mean, people talk about it's hard to build a pipeline, it's hard to build transmission. It's hard to build a bridge, right? It's just hard to do anything of scale. So power has these scale problems in it. The next thing it has is it has a heavy dose of the public sector. So some politicians, some regulators, somebody who's elected, somebody who has those thoughts or that role is involved in the decision making. And I would say one thing that we have found really fascinating about the way we polarized our energy discussions, we made it very hard for politicians to say, yeah, I'm sorry, I would like to have a clean world, but if there's a blizzard, I would like to have a coal plant. I'm sorry, I'm sorry to be that guy. I'm sorry, I said coal was good, right? Nobody wants to be that person. So everybody tries from a regulatory perspective to, well, let's just do a formula. And the formula will tell us what to do. And then we didn't have to say that we chose it. Well, when you do a formula, it depends on the variables. The formula is going to kick out certain things. And the loudest noise we've had in power has been around decarbonization. That's been a loud noise. Like, we want to decarbonize. There haven't been a lot of people saying, I demand that it is reliable. These people are harder to find. They're more diffuse. And so we've lost, somewhere in the politics of it all, we lost our focus on reliability and therefore cost. And then the punchline has become, on power, which I think is so key, it doesn't matter if you're a company or a state or a country, or in the case of, today's world, NATO, the source of your power, your source of your economic power is going to be the reliability and cheapness of your power. And so we've seen companies saying, I got to have my own power. We've seen states saying, if my power is cheaper here, we're going to get more jobs from those guys will move over here. And then whole countries are saying the whole thing. And the biggest story in today's world is the way Europe has hurt itself so much with its power policies. So there's a lot in there, but it has led to an environment which was pre-AI of people saying, I got to have my own power. I'm really worried about the grid. The grid is not easily fixed, so maybe I'll have my own power plant. So power is becoming a distributed investment where people try to take care of it themselves. Sometimes in meetings like this, it's always fun to ask, how many of you have a home generator? Usually, maybe students don't have a home generator. Maybe your parents have one.
We have them.
Your parents, you have them. But people have just, it's become the story. And then on top of it, we layered AI. You asked me to touch on nuclear, so I will real quickly. Nuclear, it's been amazing how quickly the world has changed its attitude on nuclear. I mentioned 2020 to 2025. In 2020, we shut down Indian Point in New York, which was providing carbon-free electricity to like half the city's power, 25%. It was some crazy number, but we shut it down. That's the world we were living in, which was the voices around nuclear were so negative, we were doing stuff like that. Now it's a dramatic revolution in what's happening in nuclear. And I'd say the punchline on nuclear is I feel like over that 5-year period we're talking about, lots of flavors got a shot at the title. Hydrogen got a strong look. Geothermal is certainly still getting a look, but all the flavors got a strong look. And when engineering-minded people sit down and say, I would like to have power that hits those key ingredients, boy, nuclear's top of the list. And natural gas is pretty close too. So those two flavors have really emerged as the flavors that, because it was said in the first panel, you're solving for so many things, you're never going to have a perfect flavor.
Yep.
But nuclear really sticks out as like, okay, that is a flavor. We got to figure out how to get it built, how to get it financed, but it's really exciting, and it's going to get so much capital because it's emerged as a key flavor.
And so building on that, Steve, maybe talk a little bit about how who is providing the capital has evolved. If you compare, let's say, the last 5 to 7 years when we were focusing on investing in certain kinds of infrastructure and asset classes to the capital that's needed now and will probably be needed over the next 10 years. Talk a little bit about the trends you're seeing and who's playing in the market.
First of all, I think we are sitting at the edge of time where the capital required to take us from here to there. Toby talked about the AI race. We just talked about nuclear and the grid build out and T&D. We didn't talk about this takes time, and it takes trillions of dollars. And so, I hate to be simplistic, but the answer is it's coming from everywhere. Mm-hmm. It is absolutely coming from financial sponsors, which obviously is money coming from effectively you institutions, and investing your dollars. Dennis talked about $1 trillion. There's a lot of private equity sitting on the sidelines. They don't necessarily want to focus on the upstream. A lot of folks have gotten out of the upstream business because their LPs didn't like hydrocarbons, which is unfortunate because, as Toby in the last panel indicated, We need a lot more of that if we're going to supply this world with energy, of which we are fortunate to be abundant of. We need to spend more, and we need to help deliver that as we're doing through LNG, for example, to other parts of the world that don't have it. And we need to help them build the infrastructure that they need ultimately to help. As a rich country, it's incumbent upon us to think about those folks, not just think about ourselves. But the capital is coming from private equity. It is coming from strategics. Maynard talked about nuclear. We were fortunate enough to be the folks that helped raise capital for X-Energy, big nuclear business. A lot of that came from Amazon originally. It also came from financial sponsors, NGP and other financial sponsors. And so the build out of what we're going to have in energy, in infrastructure, in other forms of energy, clean energy, nuclear, wind, solar, it's got to come from strategics as well. You talk about the funds you have. It's coming from the likes of your LS and others like yours. It is the new entrants in the business now, because a number of folks have left the quote unquote energy equity markets, public equity markets. There are still folks that don't necessarily believe that all energy is bad or all hydrocarbons are bad. Family offices have been building up and learning more and more about the energy sector and recognizing that there are good returns to be generated in the energy sector. So we got family offices, and family offices tend to work together to create almost mini institutions, if you will. So you can deliver now $1 billion to a project from a group of family offices, and that's happening on a regular basis. So I think, and by the way, there's money's coming from rich nations. You look at what the Middle East now is doing. You know, you saw Trump earlier in his about 6-9 months ago to the Middle East, and then all of a sudden come back and talk about the commitments that they're going to spend in the U.S. And we're seeing that in LNG. We talk about the investments. XRG is looking to spend $80 billion and XRG is a subsidiary of effectively ADNOC. They're looking to initially funded with $80 billion, going to $160 billion in not only clean energy, but gas around the world, because we know that gas is a much better fuel than coal. And so they're looking on a global basis, including into the U.S. So when we think about sovereign wealth funds, private equity funds, family offices, continuing, I wouldn't ignore the public capital markets. They are still funding, particularly the debt markets. The banks are still funding, notwithstanding, a lot of folks think the banks have gotten out of the business. They're back in the business because they need to be back in the business. It's bad business not to fund energy on a global basis, and for countries around the world be blaming banks that they're not getting the funding they need to help support their own folks. So a lot of sources of capital pouring into energy. And I started off on the first comment saying there is no shortage of capital. And I continue to believe there is no shortage of capital. There may be shortage of capital for bad projects, for projects that don't generate good, adequate rates of return.
At least for now.
At least for now. Yeah. I mean, there was certainly plenty of capital over the last 3-4 years under the last administration pouring into hydrogen projects, a whole host of other projects of clean energy sorts, science projects, if you will. That capital has been destroyed. Tremendous amount of capital has been destroyed, and unfortunately, that's limiting the investment flavor today of folks wanting to find more things to, because there are a lot of great projects out there that ultimately have a shot at being able to generate the next wave of energy source, geothermal. And there is funding of geothermal, but that's a source that a lot of people are banking on. So look, I think that capital, again, I hate to be so simplistic, but it really truly is and must come from all sources.
Yeah. Dennis, you mentioned how it was interesting you characterized Apollo as almost more of a credit firm. So talk a little bit about how the role of private credit has changed the way Apollo operates within the energy infrastructure space and how that links to how insurance companies are changing how they manage the liability side of their business.
It's a great question. But I'll start by what private credit is not trying to do, which is to disintermediate the banks. right? That is not our goal, right? There's a public market, there's a public debt market, a public equity market. Both are hyper efficient and very good. And it was mentioned in a prior panel, we are blessed in the U.S. with the greatest capital markets in the world, and it does spur so much of the innovation and the capital availability for all of us in our careers, and certainly for all of the companies and in the energy space and across the entire economy. Our goal is really to listen to problems and create creative solutions to those problems. And so on the insurance side, and that is insurance capital, Apollo today is powered by Athene. So in 2009, fascinatingly, Mark started Athene with $15 million of capital. Athene today is a $400 billion AUM, originates about $80 billion of annuities. And what is an annuity? An annuity is a retail that gives you a fixed return and a fixed duration. And so as I was starting to say, it's great for us to invest against that because in many ways, think about that from an investment perspective. We know our duration and we know what we're trying to beat as a hurdle. And so what we try to do is go out and listen to, and talk to clients and say, well, what really are you grappling with from a capital markets perspective or capital availability or a capital kind of capital that would suit, that the capital markets are not meeting. And what we found really is, again, is this equity replacement. It's a big one. There's other things we can do, duration and different types of pick toggles and other things that the capital markets necessarily don't want to do. But again, the big one is really providing equity-like capital. So the rating agencies are giving you equity credit, so it doesn't count against your debt. At the same point, we're capping our return at some points at a sub 7% level of return. So it's a pretty compelling product for an investment-grade issuer rather than going to the equity markets. And I think most CEOs would say their cost of capital is greater than 7% from the equity side. And as we said, that really fills a big, big hole in a lot of the capital budgeting. We were talking before I came up. Pfizer this morning came out, right, and did two things, almost countervailing things. One is they agreed to price concessions on a number of their drugs with the Trump administration, which will lower their free cash flow. And on the other hand, they agreed to a $70 billion onshoring of manufacturing, which will obviously raise their need for capital. And so it's that sort of tension and the need for capital, which we think private credit's really going to fill a hole for. But as I said, our goal is not to go out and offer a 5% issuer in the IG market, investment grade market, a 4.5% bond. That's a race to the bottom for us, and we'll just lose and destroy value. So it's really the creativity around us listening to problems that clients are having. And a lot of that is around equity content. And the other one we're finding a lot of is people in this day and age, as they start to do much more construction, whether that's infrastructure, whether that's energy, whether that's power, they don't want it on balance sheet.
Yeah.
Right? Because if you have a 5-year power build, do you want that CapEx, do you want that negative drag on your earnings and on your capital, on your financial statements during that build process? And so we're much more around also taking things off balance sheet on non-cash flow, non-revenue producing.
Right, that's it, because that's historically been a significant challenge for raising capital for these long lead time construction projects, because it ties up your balance sheet until it's deployed. So it seems like there's some innovation happening in that area. And Maynard, maybe you can talk a little bit about what you're seeing throughout your very diverse client base in terms of innovation and approaches to meeting this funding need.
I think the thing we run into the most, and we've really tried hard to work with as many different pieces of the energy spectrum as possible so that you get as many angles as possible. And I think the two things that come up the most are, people want to grow. So almost all the questions or debates we have are about growth. How do we grow? Where do we grow? Et cetera. So growth is a big issue. But then the second question that is often linked to that is, well, in this world, and you guys have heard it today, there's so many things happening that your old business model, like I used to be this flavor, or I used to only do this, or whatever your business model was, the question is always, maybe I should change my business model. Maybe I'm an oil and gas guy that should go into power. Maybe I'm a chemical company that should invest in nuclear. Maybe I'm a tech company that should invest in power. The list goes on. And so these debates, because people are sitting there and they're watching all these changes going on, and it's really hard to be a company and say, wow, that's happening right over the fence line, but I'm not supposed to do that. for some reason. Usually it's your public investors. They do not want you
That's the key.
changing your flavor. And so I think when you think about all the energy related announcements over the last year, they're almost always partnerships, JVs, unique financings, unique combination of skills, because people recognize like, I could use some of what, quote, they have. Mining was an interesting kickoff panel this morning. You know, one of the things that mining companies say all the time, which is interesting, which is, we love the technology that exists in oil and gas. How do we do more of that? So there's all these ways in which people are trying to share technology, trying to share their outlook, trying to share their balance sheet. There is, I think, to Steve's point, there is definitely capital if you have a good project. I would say there's one last thing that's an issue in today's world, which is very interesting, which we kind of lost our ability to forecast. Because the institutions that we used to have who led long-term energy forecasting have gotten really caught up in what they hope happens. And this has become a big issue. So when you said, you know, what are the things we're talking about? You're always talking about growth. You're always talking about the business structure. Those are two big flavors. But you're always honestly debating, what does the world look like in 10 years? And the sources of information for objective analysis around what it might look like have gotten more divergent over the net. And that's just an issue for companies, for governments, for investors. And so that's honestly where we spend a ton of time. And I'll give you one last one in this department, which is really interesting. If you've ever been to CIRA, it's the big conference in Houston. It's probably the biggest energy conference globally. You get 10,000 people. The last few years, I bet you would have to look really hard to find a panel on where will we find the oil we need in 10 years. This used to be the main topic of the conference. And so one of the issues in today's world is we're going to have to explore again. We're going to have to go find, and this is part of this long-term forecast. But I'm just saying, there is some really, we get so caught up in quarter to quarter and year to year and policy and politics and all this kind of stuff. We tend to lose sight of the long-range goal, and that's something that we just spend a ton of time on.
I would argue, Maynard, one of the problems is in this country, and I'd argue many countries around the world, it's gotten so divided that you can look at policy under this administration, but what's the one 4 years from now? Who knew we were going to be, when we were pouring all that money in because folks wanted to get out of hydrocarbons, we're going to be where we are today, and where we're going to be 4 years from now has a lot to do with who's in office and who's making policy, not just here in Europe and other places. So to your point, it's become very challenging to do that. I'd also, you mentioned oil and having to explore. I would also argue, by the way, and it was mentioned on the last panel, technology, it continues to evolve. I mean, this country is made up of unbelievable, not just this country, the world is made up of unbelievable, bright, young engineers creating new technologies all the time. We have a lot of oil still in place in the U.S. We're getting a very small portion of the oil that exists in the U.S. out of the ground. Problem is, it's costly to get the other oil that's down there out because we don't have the technology yet to do it on an economic basis, or prices aren't high enough to justify economic returns to get it out. If we can continue, and I believe we will, which is why I mentioned earlier, I think we will extend the runway, as we always do. There's a saying in our business, big oil fields only get bigger over time. That's because technology gets better and it brings down the cost to produce that oil and develop that oil. And I think we'll continue to find ways to get more of our oil and gas out of the ground on favorable, in good economic terms over time.
But Steve, you mentioned how our politics are very decided. And so, Dennis, I have a question for you. When our policies do seem to lurch every regime change, how do you make long-term capital allocation decisions in that?
Look, it's. I think there's two major things we think about on when we get into the investing. And given that we are fundamental investors, we do own things. We don't just move the risk, right? We own them through maturity. So it's fun to do a deal. It's even better when you get repaid. The answer is two things that we look at. AI is a massive conversation because it has the ability, it already has started to really overnight severely impact business models. Even thinking about if you go to Google today if you really wanted an answer to a question, you have to click on something. Now you don't even need to click on anything, right? So those click-throughs and those sponsorships, those businesses that were responsible for that have been massively impacted, and some have gone out of business almost overnight. But on the policy or the government policy side, it's a very, very big decision for us in terms of what do we expect the Trump administration to do. And to the point, Steve, it's a 4-year. It's kind of the little bit of the funny part about Liberation Day is that were you going to make 10, 20, 30-year investment decisions as a company based upon a 4-year administration and based upon potentially no tariffs at all in terms of onshore investing. And so for us, we have a lot of folks focused on Washington and policy in Washington, and we have a lot of people who are individual sector experts thinking about what is the underlying risk of our investment. But to answer your question, it is one of the top 2 things we think about upon every investment, and it has impacted California.
I'm thinking about LNG for a minute. We talked about the billions and billions and billions of dollars, tens of billions, hundreds of billions of dollars that need to go into LNG. Think about then the tariffs on the steel. Think about the interest rates that go into that. Think about the time delays. Biden decided he's going to pause all permitting. All of that goes into affecting the ultimate return and ultimately changes the return dynamics dramatically. And you, in the meantime, you're setting up these offtake contracts that you expect to generate good returns. You've got those in place. Going back and trying to renegotiate those are pretty darn tough just because you had interest rates change or other delays in the factors. So it's a major, major issue in the sector.
And Maynard, maybe you spend a few minutes on how are your clients reacting in that environment? And
I thought in the last panel, Tom Jordan made a really interesting comment, which was he basically said no one wants to see someone get keystoned. And I think that's a sentiment that to these points that the guys are making here is if you're making this long-term investment and you've done everything you're supposed to do, if the government, whatever government it is, the state, federal, some agency, whatever it is, if they change the game on you, that's bad for investment. And nobody nobody thinks naively, oh, well, what if it happened to them, it can't happen to me. Like everybody realizes that's not a good thing. So you definitely hear that. I think there's hope that, because I don't think that's lost on this administration. I think they, at least certainly on the energy side, they have a lot of energy people engaged directly in all this. They have a lot of business people engaged directly in all this. I think the reason you get executive decisions is because those are just faster, and they feel like we're behind on a lot of stuff, like we got to go. So I'd maybe be cautiously optimistic that they're going to try to fix some of this stuff legislatively so that we don't have that kind of environment. But it's obviously a risk, and I think maybe the best way to say it is, I've heard some executives say to me, I would rather have not great regulatory than unpredictable. So right. Give me something that's not as good, but is not going to change. They would prefer that over the toggling.
The problem we have is, think about the next president. Is it Vance? Is it Newsom? Is it AOC? Those are going to have dramatically different directions of our energy policy and our energy direction in this country, and potentially, therefore, the world. How do you make investments when you don't know where that's going? And people are making investments now in hopes that the continuation of the existing policies will be in place, but we have no assurance that's going to be the case.
I think one thing that my sense is I think the volatility would be a little bit less than maybe in the past because the fundamental drivers have changed a bit. There's real demand growth, there's real concerns around reliability, there's real concerns around the cost of energy. And so if there's a change in administration, I would hope policymakers would think twice before they do something that could actually increase in the cost of energy. And so you may see a little more of a consistency.
But we would hope.
What do you think, Maynard?
Well, I think there's one thing that's really interesting about this is we need more. This is why, to echo Steve's upfront comments, great you guys are doing this. Great you're doing it at USC. Great it's happening in California. It's great that the state has been rethinking some stuff. These things don't have to be so mysterious, right? There is data around the cost of power. There is data around the costs of energy more broadly. There is data around where plants are locating and why. So I think my other hope outside of legislative change that makes things more permanent continues to be a better conversation about these issues. I mean, these things are highly complicated, engineering-based, technical-based, financial, and we have been way too simplistic, saying this flavor is better than that flavor all the time. This is good, this is bad, so on and so forth. And we have not been thinking holistically about this. So we need some charts, we need some town halls, we need people to get on the same page. There's a lot of things that we'll always fight about, but a lot of this stuff needs to be moved out of the living room food fight we've been having, and let's settle it and fix it. And we could spend some more time fighting about the other stuff. There's data here that will tell us where to go.
My concern is, and I agree with you, and I think it's going to have to come from the ground up. I think it's got to resonate with all the people, the populace, to the politicians, because to what Toby said, we've known this. The data's there. Boston's paying the highest gas price in the world. And we got right next to that. Data has not changed. That data is there. And yet, does she do, or do the politicians do anything to solve that problem? No. And so we can have all the data we want unless we have people that are listening, and it has to come from us to make the change. Eventually it will. When it gets to be so high, there's a crisis, that's when things change. But we've got to force the politicians to listen to what's going on in the U.S. in particular, and around the world.
Maybe before we get into Q&A, if you could each take a brief few moments to just give some advice to the students out there, the Marshall students in particular who are interested in finance. What in the industry, what direction would you point them in? Maybe starting with you, Dennis.
Three things, and then maybe this is a cop-out, so you guys have answers than I do. One is, I got advice from a professor in business school, which is, don't pursue a goal where you don't enjoy the journey. The journey is going to be 95 to 98% of your life, and the goal, what you achieve, is at the end. So really make sure that you plot a path in life that you can be really, really enjoy that journey. The second one is to just follow your passion, as long as it's a productive one. And passion is really important. I think all of us on this stage have a passion for what we do. If we didn't, the long hours, the time away from home, the travel. One year I calculated my body moved at an average velocity of 55 miles an hour every hour of the year. So that was like 350,000 miles. And the CEO of my company said, well, I did 550. And I said, well, you did that on a G550. I did that on Coach. It's a big difference. You have to have a passion. And if you don't, it will be obvious, and whatever goal you may have will be impossible to obtain. And the final one, I would just say, as you climb, lift those around you. Always give back more than you take out of an organization. And that comes really easy with a passion. If you have that and you're passionate about what you do, you will mentor people, you will bring people up around you, you will have your team succeed.
Excellent.
So as I said, I'm sorry, that's not more specific around energy.
Yeah, but
Those are all good.
Wise words.
Just go with what Dennis said. No, I've gotten this question a lot over the years, and I feel like kind of to Dennis's first point, and I probably did it myself, is you overthink it. Should I go this way or should I go that way? What's going to happen? You try to think through these choices. But it is really good to just go with your gut. And I think what's interesting about your gut, when you think about it, let's say you interview at 4 places and you come back and you say, my gut is telling me place 1 is the best one. And you look at it and you're like, well, but place 2 is a better reputation, and place 3 will pay me more, and place 4 has some other attribute. What your gut is telling you is that you feel comfortable there somehow. There's something about that place that makes you feel comfortable. The people, the culture, the philosophy, whatever it is. And so the reason why you should listen to your gut is telling you, we're going to do well here. we're going to feel good here. And if you feel good and do well and enjoy yourself, you're going to work harder. The work is not going to be as burdensome. You're going to grow more, and you're going to thrive. So that's the one thing I tell you is kind of, remember that scene in Star Wars where Luke turns off his scanner? So turn off your scanner a little bit and just think about, listen to what your own self is telling you. When I left Goldman, go to TPH, it was really a hard decision because I've been at Goldman for a long time. Those are all my friends and all that stuff. And I made a mess of the decision. It took all week. I didn't shower, all this kind of stuff. And maybe a couple showers. But I remember it came down to, I was like, at the end of the day, I think this will be more fun. And my wife looked at me and said, you're not really making career decisions based on that, are you?
And go take a shower.
I said, and go take a shower. But I do think having a sense of fun and not being so methodical, because everything you've done up until now has probably been pretty methodical. I need to make good grades. It's got to look good on paper. I got to go to the good school. I got to have the good major. You've been pretty methodical. You probably haven't chosen based on fun, and that's okay. But I think as you build your career, go with your passion. And I just add one last one, because in today's world, it gets to this whole discussion. We were debating this morning on email, like me and my partners, this particular situation, and everybody's like, that makes no sense. How can you come up with that value for that? Well, that's just dumb. It's almost never the case that it's just dumb. Somebody out there who's really smart doesn't think it's dumb. So I would just say add that exploration mentality to understanding stuff, because something that might strike you, you can't figure it out. That makes no sense. I don't get it. There's somebody smart who's thought it through, and there's a reason. And if you'll go discover it, you'll really enjoy that experience. And the next time you're in a meeting and someone wants to label something as dumb or doesn't make sense or those guys are nuts or whatever, maybe. But let's just go talk to them just in case, because they might not be nuts. You'll be surprised at what you find when you go on the discovery trail like that.
Good advice. Steve?
Look, first of all, I agree with everything they've said, which is a little around the soft issues. And there's a saying in the industry, which is, if you love what you do, you'll never work a day in your life. And there's a lot of truth to that. You got to wake up every day. And if you love what you do, you'll be good at it. And if you're really good at it, you'll get promoted. You'll make a lot of money doing it. So if your goal is money, if it's to save the world, if you're good at it and you enjoy it, it's going to be great. What I would say, bring it back to energy, is that this is a phenomenal sector that needs a tremendous amount of human resource of all sorts of trainings. And it's a dynamic industry. It's changing all the time for geopolitical reasons, for economic reasons, for technological reasons. And to be able to stay on top of that, and to be able to be in a dynamic environment that's changing, and you have to change with it, is a great place to be. And you made a comment. I'll give you an example. When I was coming out of business school, the senior folks that like us today would say, look at the people, go meet the people within that organization and see who you like. Forget about the name on the door. Who do you like? What are the people that are like you? And honest to God truth, one ear out the other ear. I was going for prestige. I was going for the big brand name investment bank. And I knew if I could do that, much like, you go to the big brand name, and we went to the same undergrad, in undergrad, you chase those things. And now I'm sitting here 35 years later, I was completely wrong. People are going to make the difference. Go find the people that you get along with, people that you like. You have to wake up every day and work with those people. Find those people that you really enjoy being with in the industry you enjoy being in. And you're going to love your job. And so that's I'll leave you with that, but I'll also leave you with energy is a phenomenal sector. I've lived on it on the outside as a financier to the sector, but I've gotten to know a lot of people. Many of my closest friends are participants in the energy sector themselves. It's a phenomenal sector.
Good stuff, guys. Yeah, look, the only thing I would add is, my mantra has always been, look to do meaningful work with people you respect. And if you could do it in an industry that's growing and there's lots of opportunity, even better. So with that, why don't we open up for questions? Sure, right here in the front. Oh, you got a mic coming.
Thanks so much. Okay, guys, thank you so much for speaking with us today. So my question is, going back to previous panels where we need more companies that are on the field working to create the next solution for energy, I'm interested in how you kind of incentivize these companies in the way that, how creative is your lending, or like create this lending infrastructure so you can deploy capital for these companies to build that. And in terms of lending, or what type of lens are you looking at these companies? Is it all just like future cash flows? Do they have to have, right? Because building a solution, they may not have it right now. I mean, what's kind of the lens you're looking at in order to make that happen?
Dennis, you want
Yeah,
to start?
I'll start. So we've made a commitment that we'll invest $100 billion in energy transition, broadly defined over the next 5 years. Through 5 more years. We're at $50 billion into that already. Fundamentally, we are cash flow investors for sure, right? That is what we do. We are not VC investors investing in cuspy technologies that may or may not prove out. There are plenty of people that do that, the Sequoias, Kleiner Perkins of the world that do that, but we are cash flow investors, and usually we're first lien cash flow investors. So we have funds across every form of capital, whether that be credit, hybrid, so something between credit and equity, and pure equity that are focused on the space. And we have people across that value chain, whether it's somewhat technology or also molecule level. So we invest across the entire spectrum of the different technologies.
Why don't we go to the? Oh, you want to say something? Real quick?
Yeah.
Okay.
Keep in mind, you talked about lending. Lenders, first and foremost, first question they ask: am I certain I'm going to get my money back? They don't care about the upside. Am I getting my money back? Second of all, what's that?
There is no upside, so that's the problem. We're not.
Second of all, am I going to earn some kind of return on that interest rate? It's probably effectively the cost of that capital, maybe a little bit more for those that are lending it to you. So that's the key. So doing things that have high risk as a lender, very, very challenging. Not impossible, but challenging.
Yes, sir. I think the mic's off.
It's on now.
There we go.
You anticipated my question. I agree with Tom Jordan that historically we're foolish if we bet against technology. On the other hand, with each new wave, there are losers as well as winners. So you think about the massive overbuilding of fiber optic cable in the 90s. It took down WorldCom and Global Crossing. More recently, our automakers bet big on an acceleration in the rate of adoption of EVs, and have suffered as a result. So recently, MIT put out a study that said that 95% of AI investments recently are not earning return on capital, and some not of capital either. How do you, as lenders and investors, handicap at least the possibility that the assumption of massive productivity increases gets delayed or isn't as massive in the next 20 years as we're assuming? Because I think that has to be factored into your thinking with trillions of dollars about to be invested.
Great question. Maynard, do you want to?
Well, I just
address
throw
that?
out one thing, because when you think about the AI conversation, particularly from an energy context, but the conversation is it's so intense around where are we getting all the energy for these data centers, right? And so that's a topic that everybody's all over that. For the last 6, 7, 8 months, we've been hosting these discussions, private discussions with all kinds of energy companies of all shapes and sizes. What is the use case for AI? Like, what are you using it for, and what is it going to do for you? And I sit in all those sessions, and I guess what I'd say is I come away going, every session has some part of it where you're like, the legal department, the HR department, the problem with the data, the problem with the cloud, the problem. So you kind of come away going, it's going to be harder to implement than, you might think. But you also come away with the art of the possible feeling of like, the potential of this grows. So in oil and gas terms, we would say that mark down the near-term production, but the potential production feels higher. Who knows where it lands? The only thing I would say, and you went through fiber and these other examples, the world is always overcapitalizing something, because all this money is roaming the planet looking for the best return, and it's competing with each other. So the minute somebody is in something that looks like it's working, boy, the whole crowd comes. And that's actually what happened to oil and gas. A lot of people think, raise their hands like, we're not doing it anymore, it's dirty, so on and so forth. Well, the other thing that's not talked about is for a decade it didn't make money.
Right.
And if you don't make money, people find a reason to stop investing in you. And if you do make money, they'll come. So I think the world just does that. There's inevitable too much, but hopefully we're not there yet on AI.
And one thing I would say, unlike the early 2000s during the internet boom when it was going to suck all the electrons out of the grid and so on, you're not seeing speculative building activity in the generation space, at least. And so I think there is a discipline that's being adhered to at this moment. And I think if development is going to happen in the near term, it'll be with a long-term offtake with the customer, and as opposed to just building and hoping the market shows up, at least in the generation space at the moment. Another question.
Right here.
Nope.
Good segue into your last comment there. There's a handful of public independent power generators in the country. In response to the tremendous growth in electricity demand perceived going forward, the stocks have really, really run. They're all able to continue to buy private power assets from really private equity and private credit sellers at very attractive multiples. So I'm wondering what it is you guys see on the private side, and if you panelists, or perhaps the moderator, as to what the math is on selling those portfolios at what appear to be very attractive prices at a time when demand appears to be rising and high.
All Pinterest.
And nobody is building new power assets.
Right. This feels like a very personal question.
Not at all.
So we've done a few of those monetizations to the
One of
public
shareholders.
independent power producers, and there's a moment where the transaction can work for all those involved. These public companies are trading at higher multiples than they have in the past. The cash flow coming off these assets is higher than they have been in a long time off of gas-fired generation. So there's an opportunity for both sides to get a transaction done that's fair, that works for both sides. I think what you're going to see is often what happens when you have shifts in fundamentals like this, liquidity comes to the market. For many years, at least on the gas generation part of the business, assets were not really moving around that much. And you had an opportunity to really buy them, we think, at historically low prices, which we were able to do. Now that the fundamentals had demonstrated that these assets weren't ice cubes just melting and that they're actually needed for the reliability of the system, capital is coming in, public companies are coming into the market, but also sellers are emerging. And if you look at some of the numbers, around half of the power plants that are in the deregulated markets are owned by financial type investors. So I think those assets are going to continue to come to the market. Investors like us will continue to buy those assets. And then I think the independents are now in the game. They haven't been in the game for a while, but now they're there.
One other element I'd add is mostly all these private equity firms have finite lives to them. And once they've achieved a certain return, and particularly if they're getting late in their fund life, they need to find a time to monetize. And if there's a buyer out there, even if it looks like an attractive multiple, they're going to generate a good return, to your point, and the buyer is going to get it at a reasonable value. There is some new development in private equity now, which is called continuation vehicles, that will now allow you to extend the fund life and then allow you to keep these assets for longer. So if these assets have still great growth to them and great value appreciation going forward, you'll start to see more private equity firms hold these for a longer period of time to achieve more of that value.
One last quick chip shot on that too, which is we focus on AI as a demand driver for power and energy. The truth is the electrification of our country is on, right? It's not just that. When Pfizer makes a $70 billion commitment to building manufacturing facilities, when other people are making $50, $100 billion manufacturing facility bets in the US, that's all electricity. So there's going to be a massive demand on the power and energy side. As we said, whether it's 50%, 75% of the AI gets built, but there's still just a massive intrinsic demand for power.
There's one theme here, if you don't mind, that I've heard. I heard it in the mining panel. I heard it in the question on power. It comes up a lot. It comes up in turbines, which we're short on turbines. Everybody hears this. But public investors, it comes up in exploration as it relates to oil and gas. Public investors are not only focused on your profitability, but they're focused on their dividends and do not invest speculatively. So do not build a power plant unless it has a contract. I would rather you buy producing oil properties than do rank drilling. I don't want you to just ramp up mining capacity because you think EVs are coming. All this goes on and on and on. And what it does is it creates a short-sightedness in our system, and it's part of why we get the boom-bust cycle, because once you realize, oh God, we're short, then you have this explosion. So that the influence of the public market on valuations and on spending and on investments is really strong, and it ends up filtering into the private market. So it's a lot of dynamics here, but particularly around building capacity, boy, the public investors just hate that.
I think with that, we're going to wrap it up. But I wanted to thank all the panelists for their time and thank the audience for their attention and their questions. Appreciate it.
Thank you.